As I just mentioned, stocks higher in the United States. Many investors comfortable that inflation is now sufficiently under control for the Fed to begin cutting interest rates. Let's get more from Michael Landsberg, Chief Investment Officer at Landsberg, Bennett Private Wealth. Thank you very much for coming on the show.
Thanks, Ed.
Just to get the Fed out of the way, I guess we should remember it's when the Fed's cutting rates, it is a sign that it's concerned about the economy.
Absolutely. I think that's one of the reasons we think they're going to be very slow and steady with these cuts, simply because you don't want to spook a lot of the investors that maybe the Fed sees some things that the rest of us don't see. So we're expecting 25 basis points, and we'll kind of see that, I think, over the next few meetings. But yeah, typically, it's not a great sign because it means the economy is slowing. We've been saying that. We think you're seeing a slowing economy, and that's going to be tougher to find some growth names to be able to make money in.
What are we seeing a rotation in the stock market? Are we seeing a while ago we heard a lot about this move back into small caps, but since then a lot of the mega caps have been rallying. But are we seeing a shift in the asset classes people want to own in the stock market?
I think so. I mean, we're not big fans of small cap. I think small cap's still negative for nearly 3 years. So we think 40% of that index doesn't make any money. So we're a little bit more of a wait and see in small cap. But I think you're seeing a rotation. We're in a slower growth environment. Inflation's come down. Those typically are times to invest in defensive stuff. And so basically, we would think that started about a couple months ago. And so you've seen a rotation into utilities, away from industrials, into real estate, and into healthcare. Those have been areas that have done well, more defensive names. And the last, let's say 90 days have kind of shown that out. There is a little bit of a rotation because tech has done so well.
You have some stock ideas for us, and this is one we don't talk about much. Arthur J. Gallagher, AJG in New York, the tobacco company.
No, Arthur J. Gallagher is actually the insurance broker.
Oh, I'm sorry, stupid of me. Yeah. Go ahead. So it's insurance broking. Okay, go ahead.
And what they do, what's kind of neat is we've been seeing inflation, in the United States very high for a while. And insurance premiums are much higher than just the regular stated CPI numbers. So what way for you to play inflation is to invest with the companies that are basically pricing your insurance, whether it's car, auto, et cetera. And there's a host of them. We like Arthur J. Gallagher because of that. Very consistent business, low beta business, but they're very, very profit centric. And as prices go up, their margins go up. So yeah, it's been a good place for us to be for the last year or so. We think they'll continue to do well.
Oh, okay. I think I was thinking of Gallagher, a British tobacco company there.
Yeah, absolutely.
Okay. Your next idea for us is BNN Brands. What do they do and why do you like them?
BNN is actually really it's a play on derivative of the GLP-1 success. Everyone knows the Mounjaro, Ozempic story, lose weight, but a lot of times it's creating loss of muscle since muscle weighs more than fat. BellRing is a pure play in the protein, ready to drink protein drinks, the shakes, candy bars that are healthy for your protein. And so what we're seeing is you need to intake more protein to be able to put muscle back on. So while we like the GLP-1 stories, they're expensive. And so this is a way for us to be able to play this phenomenon, if you will, of more and more people taking these drugs, losing weight, but at the same time losing muscle. They're positioned right. And again, it's a pure play. It's not a small part of their business. It is the main part of their business.
And then finally, Constellation Brands, the beverage seller.
Yeah, we typically always seem like beer, and we're coming into football season in the United States. Yeah. We think that's a good spot to be. They're the distributor of Modelo, which has been a great story. They got rid of some of their low-margin wine business, just wasn't working for them. So we think they're well positioned. Again, these are three fairly defensive names, kind of given the environment we're in. We'd rather be on defense a little bit here. We've taken down our tech allocation and our tech exposure back about 90 days ago, and these are some of the benefactors of that.
Okay, I'm sorry, you said you have been trimming your tech exposure, just too much AI optimism?
Yeah, I mean, we rebalance twice a year. So we rebalance basically the end of June, early July, took our tech exposure back down. Why? Because it had been such a good performer. And so typically what we want to do is we want to rebalance or take exposure down when it's outperformed and look for other places to allocate. And we did think we're going to go into a slower growth environment. Inflation started to come down a bit. And typically tech's not a great environment for that to be in. So while we still like the AI story longer term, we want to diversify away from that story, be thematic diversifiers, not have all of our eggs in the AI basket. Even though it's a nice basket, there's a lot of other places to invest that have value and that also will smooth out the rides in bumpy months.